I'm Andrea Johnson. I'm the Grant and Financial Education Coordinator for the Office of Consumer Credit Commissioner. I want to point out that this webinar today is for informational purposes only and does not constitute legal advice. And today we're going to be talking about credit and saving. First, before we get started though, I want to point out a little things about the Texas Office of Consumer Credit Commissioner so you know who we are, where I'm coming from. The OCCC licenses and regulates certain non-depository institutions in the state of Texas. That involves pawn shops, payday loan lenders, and registered creditors. We protect and safeguard people like you against abusive and deceptive lending practices, and we educate you and creditors about your rights and responsibilities. If you have any concerns about any of the places that we license or register, please contact Consumer Assistance, our Consumer Assistance helpline. The number is on the screen. There is someone actually there who can address those concerns, address your complaints, and also even walk you through any fine print on a contract that you don't understand before you're signing with any of these institutions. We also provide financial education through me, the financial education coordinator. We provide informational seminars and webinars like this one. I used to love doing this in person, but since the pandemic, things have changed. We provide financial education materials like the handouts I have today, and those are also on our website at occc.texas.gov. And we partner with other education-oriented organizations. And I like to mention this because I am also the grant coordinator for our office. And what we do is we help manage the Texas Financial Education Endowment. This is a 2-year grant cycle that gives funding to organizations across the state of Texas who offer financial education programs for their communities at low or no cost. And they can be focused for K through 12, adults, and financial education. So if you know anyone who is already doing financial literacy programs in their community, right now we're partnered with the Girl Scouts in Northeast Texas, Family Elder Care here in Austin. So it's a wide range. We've had Goodwill Industries with us before. So it's a wide range of different organizations that can benefit from our grant funding to help build those financial programs in their communities. And that's something I'm really passionate about. Again, we're talking about credit and saving. This webinar is for informational purposes only and does not constitute legal advice. Someone put in the chat box, and one of their concerns is, I regretfully didn't start saving when I started with the state. I'm much nearer retirement than not. What is a better way for saving at this point, a 401k or a savings account at the bank? And I can see where that's a big question. And of course, you want to be plotting things into your 401k. I know some people, there's so many different things you can do. And if you are a state employee, the Texas Saver program will have all kinds of information on different retirement options and things like that. And I know on ERS's website, they on their calendar do a they'll show like Texas Saver. They partner with them and have speakers come on and help to talk about retirement plans and things like that. Again, so credit and saving. This is supposed to be a high-level, quick webinar, hopefully 30 minutes or less. Get you in and get you out. Today's goals: understanding the importance of good credit and setting financial goals to help save money. Saving money is a big concern. We're going to start off with a real quick question. This is just kind of, get you guys thinking, get your feet wet kind of thing, I guess, and, just kind of see if we're all involved. So how do you define credit? There should be a poll on your screen right now, and you just kind of go through, click what you think makes the most sense. And of course, there's one that's actually the correct answer. But when you look at these, some of them are half funny, and some of them, and one of them is the real answer. And it's just kind of, lighten the mood, get you thinking, and get us all involved in today's presentation. So it looks like everyone is right on track, of course. You know, money it's credit is having money to borrow so you can pay for things later, but you must pay it back. Of course, everyone answered that. And that's what we want you to do. So why is it important to have good credit though, and why do you need it? Well, like we just said, credit gives you the financial power to qualify to borrow money and to pay for goods and services over time. And then you are entrusted, someone trusts you to pay that money back. Now, good credit and having credit helps you get a job, a better job, helps you rent an apartment, a better apartment, buy a car, get a loan, spread out payments, phone service, credit cards, get insurance. These are all things that credit has to do with. And you might not think, oh, get a job, but it does. And having good credit, if a future employer looks at your credit report and sees that you're not very fiscally responsible, they might question how you're going to help them manage money as well. Good credit versus bad credit. What does this look like to a lender? Good credit means that you're reliable in paying your bills on time. Companies are more willing to extend credit to you, and they might offer you lower pricing. Bad credit could look like that you're unreliable in paying bills. And I say could because this may not necessarily be your situation, but to a lender, that's going to be their concern. It could seem that you have a high debt to credit ratio, your bills may be paid late, your debts have been abandoned, or you've even filed for bankruptcy. And there are several reasons why a person would need to file bankruptcy, but that's going to be on your credit report, and a potential lender is going to be able to see that. There are 3 different kinds of credit account categories: open, installment, and revolving. Credit cards are an example of a revolving credit account. It requires ongoing monthly payments depending on your balance. Interest rates typically range from 14 to 30%, 30%, and usually requires a minimum monthly payment. But I want to say beware of making minimum payments. The reason is because as you're making that minimum payment, depending on your interest rate, you're still accruing those monthly interest fees on top of it. So your balance is just constantly going to be up there, capping out almost every single month. Car loans are an example of installment credit accounts. And of course, these are secured or unsecured, and typically a car loan is secured with your vehicle. It's a fixed amount of money you borrow and you pay back a set monthly amount, and that's why car loans are a good example. And also your student loan would be an example because you're going to have a fixed monthly amount, but it's unsecured because they can't take back your education. Your credit score plays a big role in your interest rate. So the better your credit score is, the better your interest rate is, and that will help you, get farther along when you're making payments. And remember to read the entire application, including all the fine print. And like I said at the beginning, if you have any questions about that fine print, call our Consumer Assistance Helpline. So when it comes to loans, there are generally fees and interest. Fees are charged for activities like reviewing your loan application and servicing the account. I think of mortgages a lot with this because mortgages have a lot of fees associated with them when you take out a mortgage loan. A credit card company, for instance, might charge you an annual fee of $30. You see those advertised where they say no annual fee or low annual fee. And then the interest rate is the money a financial institution charges, and those can either be fixed or variable. Fixed is always my favorite because they stay the same, except with some credit cards. The rate may be changed if the bank gives you the required notice, though. So you'll see that occasionally, you get statements about your credit card changing. Target is generally one that always sends those out, where it says like, oh, your interest rate could be changing to this. They send those out all the time. Variable rates might change during the loan term. So those go up and down even during the loan. That's why fixed is exactly what it sounds like. It's fixed. Secured and unsecured. So a secured loan It guarantees to the lender that it will be repaid by putting a lien of credit on an asset you own. For instance, your car, your home, things of that nature. Unsecured is given without any collateral, like your student loan, but typically there's higher interest rate. Your student loan, like I said, they can't take back your education. It's in your brain, so it's not like they're going to get that back if you default on your student loan. So collateral is going to be the security you provide the lender, and it's an asset, and a guarantee is a form of collateral. And sometimes you might have a cosigner or a guarantor on a loan. And cosigners are really great if you're just starting out and you need to get a loan, you need to get a car loan. My first car loan, of course, my mom was my cosigner. So having a cosigner is really helpful, but then that cosigner takes on that responsibility of if this person defaults, and this is anyone listening that might be thinking about cosigning on loan, if this person defaults, can I pick up the tab and pay for whatever the loan is? Because then that's going to affect your credit. Secured credit cards, I think, are a great way for anyone who's just starting out, trying to establish credit or trying to rebuild your credit. It uses money you place in a security deposit account as collateral. So let's say you deposit $200, as the example is here, then you would have a $200 credit limit. This secures a credit card, and that will also help build and establish your credit. This might be good for you if you're trying to reestablish your credit too. The security deposit just gives the lender the confidence that you will pay them back, even if you have damaged credit or no credit history. See, establishing and reestablishing. These are less risk for the lender. It's not the same as a debit card. And like this instance, it says a prepaid debit card. And that's not the same as your debit card that's tied to your bank account. If you're using your own money to make purchases, not money borrowed from the issuer. So a prepaid debit card, you're getting the debit card and it's coming out of a bank account. So how do lenders determine your credit worthiness? Creditors typically look at the 3 C's: character, capacity, and capital. Character, how you've handled your past debt obligations. Capacity, how much you can borrow comfortably, and that's going to include your debt to income ratio. And capital, which is your current available assets, such as your real estate, your savings, and your investments that can be used to pay back the debt if you can't. Here are a few things you need to know about before you start entering into any contracts, just so you know that there's something in your corner. So under the Fair Credit Reporting Act, you're entitled to a fair and accurate credit report, meaning if you find something on there, for one, you're entitled once a year to have a free credit report, and we're about to talk about that in a second. And secondly, it needs to be accurate, meaning if you find errors or mistakes on your credit report, you just don't have to take it. You can dispute it and get those fixed. The Equal Credit Opportunity Act prohibits credit discrimination based on your race, color, religion, national origin, sex, marital status, your age, or even if you are drawing public assistance. The Credit Repair Organizations Act prohibits untrue, misleading representations and requires certain affirmative disclosures in the offering or sale of credit repair services. So as we're seeing all those commercials right now, because it's a new year, about getting your credit repaired or getting out of debt, there's something here to protect you in case you accidentally agree to something that you didn't realize was what you're agreeing to. Under this act, companies offering credit repair services cannot demand advance payment. So if you're looking at someone's fine print and they say, oh, well, you need to pay us $50 in advance for this, or however much money, that's a no. You should red flag them and say, no, thank you. It requires that a credit repair contract be in writing and gives you certain contract cancellation rights. So it gives you rights. That's why the Credit Repair Organizations Act is important, because it still gives you rights as a consumer to say no. What's in a credit report and what's a credit report and what goes into one? Well, a credit report tells lenders who you are, and it tells them your current name, any previous names, your maiden name, of course. It's going to have your addresses, your former addresses, your employers, your former employers, and their addresses. It's also going to show how much debt you have. It's going to show whether or not you make your payments on time. That's where your credit history comes into play. It's also going to show whether there is any negative information about you in public records, liens, bankruptcies, judgments, things of that nature. That's going to pop up on your credit report. But what's not going to be there is your race, your religion, your criminal history, things of that nature is not in your credit report. That's called a background check. So this is kind of what your credit report should look like. And you'll see that, it'll have your name, the date of report, any employers you have, your address, the personal information. So your address, your social, your date of birth. It's going to show any potential negative remarks, any accounts in good standing, and we want that one to be good. And then requests for credit history. So these are credit inquiries, and credit inquiries can stay on your credit report for 2 years. So always think about that as you're going and you're applying for credit cards. I like to point out that a credit application and a credit pre-approval are two different things. Just because you're getting a pre-approval notice, it hasn't affected your credit report, your credit score. As soon as you fill out that pre-approval and send it back to the company, now you had a hard inquiry, and that will be on your credit report for 2 years. And legally, it can be there for 2 years. There are 3 credit reporting bureaus: Experian, TransUnion, and Equifax. They do not make credit lending decisions. They only maintain and compile the information about you and from your creditors in the report. And if something is incorrect, you can dispute it with the creditor and the credit bureau. And this says 1 free credit report per year. And this is true normally, but right now in 2020 and now in 2021 through April, you can actually get a free credit report. I believe it was once a month. I think it's once a month. Yes, monthly through Experian, TransUnion, and Equifax. I made myself a note so I wouldn't forget. And that way, they're just doing this because due to the pandemic, there's been lots of scam and fraud going around surrounded by the pandemic. And so the credit reporting bureaus did this in order to help everyone out, help consumers. But after April, once a year. And I told you this would be a quick one today. Do you have any goals for saving money? Yes, no, or have you not even thought about it? We started this off and people were talking about retirement. They're talking about ways to save money. Those were financial concerns that we had today. What are you thinking about as far as finances go? What is your financial goals? And, do you even really think about certain things being a financial goal? Because a financial goal also includes the fact that I want to put a deck in my backyard. Well, I need money to put that deck in my backyard. So that would be a financial goal, saving money toward projects like that need that extra income to make it happen. And it looks like everyone pretty much says yes, we have financial goals. Or, someone says no, and then no one said that they hadn't even thought about it. I think about financial goals, I think all the time, even over the littlest things, like repairing my bathroom sink. And it's not even a big fix, it's a small fix. So we're talking about saving. You want to pay yourself first. And you might think, well, how do you put money away in savings before paying your bills? Well, that's where your budget is going to come in, okay? You don't want to I have a second screen right here. You don't want to wipe out half your paycheck and put that in savings. So you need a budget and you need to figure out how much to put in savings first. And then I would set up probably a direct deposit. So it's money that you're not seeing, so you're not spending it. Why would you want to save money before paying your bills? There you go. It's easier to save money if you don't get used to spending it. What are some of the things you might want to save money for? And these are little things, well, a new car may not be a little thing. And nowadays cell phones are not little things either. But, clothes or giving to charity, you got to think about your budget. Think about your miscellaneous items. Think about the different things that you're spending every month and what categories those are going into. And then pay yourself first. And paying yourself first also means, savings towards the things that you want, the things that you need, and paying off debt. That might be something that you're trying to do as well. The importance of saving money. It helps you to become financially independent. It helps you save for the things that you need and want, and it prepares you for using financial products. This is good for our younger crowd because, they may not have a lot of, if you've got a teenager in your house or someone who's going off to college, they may not understand the importance of saving money. A lot of us are farther along in our careers and our life paths, I guess, so to speak. And, you've used some financial products, but there are adults, if you've got someone, a family member who's moving here from a different country, maybe an older relative who hasn't really had to deal with their finances much, a lot of an older generation, it might have been one spouse or the other who was taking care of the finances, and maybe someone has passed. So helping them to establish and use financial products through savings and like building a savings account is a good way to encourage sensible spending and to help people along their financial paths. There are different savings options. There are two basic ways to save money. Open a savings account that's backed by the FDIC, or invest your money, not federally insured, and you can lose value. I know we were all recently paying attention, well, maybe not paying attention, but if you flipped on the news recently, you saw the GameStop thing where stocks were going crazy this last month. And so, but the thing is, goes up, get money, goes down, lose money. So you're playing there when you invest, but some people are good at it. There's also interest when it comes to saving. Interest is going to be the amount of money financial institutions pay for keeping money on deposit with them. So you're going to accrue interest, and you want to think about maybe compound interest, which we're going to talk about, which will get you more money in your pocket. Sorry about that. This is going to be expressed as a percentage. It's calculated based on the money in your account. So more money in your account, more money you will get. Compound interest is money you earn on previously paid interest. So this is good. You're getting interest on top of interest on top of interest. The money in when I was saying interest on interest, I lost my train of thought. When the bank compounds the interest in your account, you earn money on the previously paid interest in addition to the money in your account. Now, all savings accounts are created equal, though. This is because interest can be compounded daily or annually. You can see that on your screen there. So take a look at this chart for compounding interest. So let's say you start a savings of $2,000 and you have compound interest over, well, the first column is no interest, and it's annual interest rate of 10%. This is no compounding interest. At the end of 5 years, you'll have $3,000. So you're still making a little extra money, but not as much as if you have compound interest. So 10%, and it compounds 12 times over the year, 5 years. At the end of 5 years, you've got a little bit more than $3,000. And then you see that last column. Let's say you let it sit there for 10 years. I would do this. So for 10 years, and you're going to have over $5,000. So you've taken $2,000, turned it into over $5,000 just by having it in an account that has compounding interest. So that's a slow but steady way to gain some money based on interest. And it looks like there's a category out of this little graphic right here, intermediate goals. So one thing about budgeting and working on your finances is setting short-term, intermediate, and long-term goals. Short-term goals are little things like maybe you want to go to a concert, maybe you want to buy someone a birthday gift. I mentioned the fact that I need to fix my bathroom sink, and I'm talking like the little plunger thingy, not replacing the sink. Okay, so this would be a short-term goal, but it's something that I need to set aside the money and the time in order to do. Intermediate goals are going to be 1 to 4 years, and that's going to include maybe a down payment on a vehicle, extended vacation, or major home repairs. You know, when you're thinking about a down payment on a vehicle, there's just a small amount of money that you could be setting aside every month for a down payment. Long-term goals are going to be like a down payment on a house, buying a new boat, or retirement. And there are lots of questions today about retirement. And when specifically talking about retirement, if you are a state employee, I'd really suggest visiting Texas Saver to find out more information specifically about your retirement needs, because state employees do have a little bit of bonuses there, so to speak. Yes. So achieving your financial goals. You want to write down your goals and make them visible and be specific and make them achievable. So you might think, oh, this is very 2019, but writing down your goal and making and posting them somewhere where you see them is a good way to keep you on track. For instance, I have them posted by my door, and my door's over here, obviously, if I keep looking this way. And I have them posted on my door, and that way I see them, my husband sees them. Anyone who comes in and out of my house is going to see these goals and see what I'm trying to work towards. You want to write down how much it's going to cost, not just the money that it's going to cost you, but you want to consider your support system and any sacrifices that might be necessary. So if I've got financial goals and my husband has financial goals, we need to communicate those, because while we both want a new deck on the back of the house, he is going to have to probably make the physical sacrifice of installing it. You want to communicate and rank your goals and share them with your family members. That's really important. And so that way you have like a cheering, you have a cheerleader and someone in your corner who wants you to achieve these goals. You want to establish a timeline. So let's say it takes $1,000 for a car down payment over 18 months. You want to set aside roughly $56 a month. $56 a month, family of 4 right here, and that is not eating out 1.5 times a week, really. I mean, sometimes mom's tired and so is dad, and we tend to eat out. So that's not a lot to save up that kind of money in 18 months. And you want to be flexible and keep your eye on the prize, but don't get discouraged. You want to look ahead to what you want, but if you have a setback, I mentioned that, 2020 was really rough in my house as far as our pets go. We have aging pets, and they had a lot of financial, medical issues that came up, and that really cut into our finances. But that's okay. Those things are going to come up, and you're going to just have to reassess and move forward and try to fix that. And keep going and plodding along and putting money in your account. So the key takeaways today is that you want to monitor your credit report by checking your credit report. Monitor your credit by checking your credit report. You want to use your credit wisely in order to build good credit and history. And you want to build a savings account, hopefully one that works for you. So a lot of questions today were about saving and 401k. So look at different ways, like maybe you want to invest, maybe you want to open savings accounts, maybe, put more towards your 401k, depending on where you work. Some places do matching, so that's another thing to see. Just see if you're even getting all the benefits you can be getting from your employer when it comes to putting money towards retirement and saving. Again, I am Andre Johnson. I'm the Grant and Financial Education Coordinator for the Office of Consumer Credit Commissioner. And you can follow us at Texas Financial Education Endowment on Facebook and on Twitter at Financial Ed Texas.